The Fed kicking off a two-day policy meeting starting tomorrow with a decision that's expected on Wednesday afternoon. Joining us right now on some of the items that Chairman Jay Powell will be considering this time around is Roger Ferguson. He is the former Federal Reserve Vice Chair and a CNBC contributor. And Roger, this is a really interesting time for a Fed meeting. The market has been very worried about an economic slowdown coming. What's your thought on where we stand on the economic front right now?
Look, right now, the incoming data has shown that the economy is in good shape. But as you point out, some of the forward indicators are raising concerns. Obviously, the market itself, as you say, we saw some consumer sentiment numbers that were not very positive. Some think that, energy prices are showing weakness because of fears about growth. And so right now, I think the Fed is appropriately in a wait-and-see mode, and we'll see at the end of the meeting how they assess all of this. I don't think they're going to take any major action. I think the real question is going to be, what are the dot plots that tell us, the SEP tell us about their mindset as they exit this meeting?
The other issue that the market's kind of wrangling with right now is whether we are dealing with increased inflation potentially from tariffs. That's not what we got from the CPI or the PPI last week. But there are all these questions that if you put tariffs in, that it could lead to at least a one-time spike in prices that could show up in inflationary ways. I just wonder how quickly the Fed would be willing to act on that, or if they think it's going to be transitory inflation. Once again, if they're gun shy from thinking transitory last time around, how does the Fed put all of that into their thinking and model things out?
Look, I think a couple of things on inflation are going to be very important. One is, as you point out, the uncertainty about the impact of tariffs. But secondly, there has been some indication that long-term inflation expectations, as measured by survey data at least, are starting to become a little bit unanchored, which would worry the Fed a great deal, because then you'd have a double whammy of prices that go up once, perhaps, from a tariff, in the face of markets that are expecting more inflation, and consequently the cycle might pick up again. I think the Fed would be very reluctant to be, in the transitory camp this time around. So my bet is they're going to be, on high alert, hoping that inflation continues to go down, but not certain. The degree of confidence around the disinflationary trends has got to have eroded somewhat in the face of all this uncertainty about both tariffs and potentially higher inflation expectations over the longer run.
Okay, so that's the key. I mean, the Fed has this dual mandate. They have to worry about the economy and they have to worry about higher prices. It sounds to me like you're saying the concern about inflation and higher prices is going to win out over concerns about a slowing economy. And maybe that's counter to what the market seems to have been betting over the last week or so. Just this expectation that rate cuts might come sooner rather than later, based on concerns around the slowing economy. That's not what I hear from you, though.
No, exactly right. What you're hearing from me is they should be very cautious now. I think they've re-won some credibility on the inflation front after getting off to a slow start. I would caution against focusing too much on the unemployment story or the slow growth story at this stage, because it's really important to keep inflation under control. And we saw how painful inflation is when it is not under control. So you're hearing from me, I would lean more towards this, make sure we got the inflation genie in the bottle, and let fiscal policy and other things deal with the potential slowing of growth. That's exactly the way I would lean it. I'm not sure that's where they'll come out, but I think that would be the wiser move.
And I guess what you think, just in terms of market expectations, this idea that a rate cut could come in the next couple of months.
I think that's wrong. I think the market is getting itself excited about possibility of a May rate cut. I just think it's highly unlikely. I don't see anything in the data that suggests that should be the case. One can parse the incoming CPI report and say maybe it was not as positive as the market thinks. Much of that was driven by one sector, which was transportation. And so I think wait and see until we get some clarity is a better move than cutting precipitously or early, only to have to adjust later. Nothing right now suggests that they need to move at all until there's greater clarity. And I think the market, if it gets itself into a place where they're expecting a cut in the next meeting, is probably going to be disappointed.